The investor tested by time. A behavioral, strategic, and compounding perspective. Markets test intelligence, but time tests character. A time-tested investor is not someone who predicted every cycle correctly. It is someone who survived cycles without abandoning discipline. In investing, survival precedes success. 1. Time as the ultimate filter. Short-term success can result from luck, favorable cycles, excessive risk-taking, but time exposes fragile strategies, over-leveraged positions, emotional inconsistency. Investors who endure across decades prove not prediction skill, but structural resilience. 2. Compounding requires endurance. Compounding is exponential, but exponential growth only occurs if capital remains invested, strategy remains intact, emotional control remains stable. Investors influenced by Warren Buffett often emphasize long holding periods as a competitive advantage. The greatest edge is not speed. It is durability. 3. The behavioral test. Research by Daniel Kahneman shows that humans experience losses roughly twice as intensely as gains. This asymmetry creates emotional stress during downturns. A time-tested investor has lived through volatility, experienced drawdowns, resisted panic. Time does not just grow capital. It trains emotional tolerance. 4. Myopic loss aversion and maturity. Behavioral economists Shlomo Ben-Artzi and Richard Thaler demonstrated that frequent evaluation increases perceived losses. New investors often monitor constantly, react quickly, shorten holding periods. Time-tested investors reduce monitoring, increase patience, trust predefined rules. Experience gradually shifts focus from daily fluctuations to long-term trends. 5. Identity evolution. Early-stage investors often define themselves as traders, opportunity seekers, market timers. Over time, identity evolves toward capital allocator, risk manager, long-term owner. Time reshapes identity. Identity reshapes behavior. Behavior reshapes results. 6. Risk perception changes over time. Younger investors often fear missing upside. Experienced investors often fear permanent capital loss. Behavioral mistakes. Overconfidence. Time shifts focus from excitement to preservation. The time-tested investor understands avoiding catastrophic mistakes is more important than chasing extraordinary gains. 7. The role of drawdowns. Every long-term investor faces market crashes, bear markets, periods of underperformance. Time tests whether strategy survives discomfort. Investors who endure downturns without abandoning structure build psychological resilience. Resilience compounds alongside capital. 8. What time reveals? Time reveals whether leverage was excessive, whether discipline was genuine, whether strategy was sustainable, whether ego was controlled. Short cycles reward boldness. Long cycles reward consistency. The core insight. The investor tested by time is not defined by perfect timing. They are defined by staying invested, avoiding emotional overreaction, maintaining structural discipline, protecting compounding. In investing, intelligence may start the journey. Time decides who remains. Markets fluctuate daily, but time rewards those who endure.